My name is Christopher, and you're welcome to Unconomics. Two friends went to a bank to make deposits. The first person deposited 10 reais into a current account, and the second person also deposited the same 10 reais, but this time into an investment account. So, 1 year later, they returned to the same bank to see what's going on with the money they have deposited. While the first person who had deposited 10 reais into a current account also met the same 10 reais in the account, the other person who had deposited the same 10 reais into an investment account met both the 10 reais and this. Now, while the first person only met his money, the second person met his capital. And that brings us to the question, what's the difference between money and capital? Money can only be a capital when it has an ingredient of growth, most often through interest or equity. An interest is what is paid from the earnings of a particular money that is invested, while an equity is also the share or the percentage part of wealth of the person that did the investment, whether he did it by money or by any other means. Now, the underlying factor here is the investment. There is no need for someone who wants to leave his money for some time in the bank to use savings or current account. An investment account is also preferred in this situation because it pays interest. And not only that it pays interest, it also pays high interest. And this interest that it pays can come in two forms. Number one, the simple interest, and number two, the compound interest. The simple interest is the interest that is agreed on a flat basis. Let's just say you invested 1 million reais at the interest of 10% per annum. It will pay you 1,100,000 reais at the end of the year. But if it is 10% compound interest per annum, you are going to get more than 1,100 reais, because every month it sweeps both the interest into the principal, that's the main investment amount, and also use the new figure, the grown figure, to count for the interest of the following month. This it will have to do all through the tenure of the investment. When it comes to equity, let's say a company is worth 1 million reais and they needed an investor. You could come in and say, fine, I'm going to give you 500,000 reais. And by that, I have acquired 50% stake in the company. With that, you own half of the company. If the company happens to declare profit, you also get your profit share commensurate to your share percentage in the company. These are two ways by which, or major ways by which, money could be turned into capital. In the next episode, we are going to look at different ways to either deposit or invest our money, and how we can go about our use and decision making concerning money in a way and manner that optimizes our own benefits.